Hi, everyone. Welcome to our webinar on pricing climate risk into the financial markets. I'm Michael Lear, board member at ICF, and in my day job, I'm a private wealth advisor for Capital Group here in New York. I'm actually sitting here in my home in New Jersey, but one day, hopefully soon, I'll be back in the city. Anyway, thanks for joining us. Before we get started, I'd like to share some background on the Impact Capital Forum. The Impact Capital Forum was founded in 2003 and was previously named the Microfinance Club of New York. Since that time, we've expanded our scope to address all aspects of financial capital, human capital, technology, and natural resources that benefit the world through the lens of financial services. ICF now has over 3,500 individuals in our network, and most members are professionals with a background in financial services, financial inclusion, and fintech. However, membership is open to anyone that supports the club's mission. We host approximately 25 events per year on a wide range of topics relevant to impact investing and social enterprise. Later this week, we'll be hosting a conversation on the next phase for opportunity zones. If you enjoyed today's conversation, and I'm sure you will, I encourage you to consider membership. It's relatively inexpensive and a great way to show your support for our community. And with that, I'll hand this over to Jeff Gitterman, who will be hosting our panel. Jeff, take it away.
Thanks, Mike. Really appreciate it. Sorry for the delays, everybody, but we'll kick it off quickly. I'm going to let each of the panelists introduce themselves when we start off with kind of our first round of questions. I'll just introduce myself briefly. My name is Jeff Gitterman of Gitterman Wealth Management. My background really is on climate risk, from how it impacts the capital markets. We run the United Nations Sustainable Investment Conference and the TV show The Impact on FinTech TV, which also hosts the digital asset show as well and is seen globally, worldwide. Also hosted Climate Week in New York City with the Nest at the Javits Center back in September. So that's a big part of our focus. I'm excited to have the panel that I have today. It's not very often that people really get to hear the nitty gritty of what's going on in the background about what I call the great repricing. But before I even go into that, I just want to say when we talk about climate risk, we're talking about two different subsets of risk. We're talking about transition risk, or the risk that there will be a carbon tax or a carbon price, and that companies that are pushing out a lot of CO2 emissions will have to start paying for those emissions that they're spewing into the atmosphere, or they'll have to buy offsets for that CO2. And what will that pricing impact be on the companies that spew the most CO2 emissions into the atmosphere, like fossil fuel companies, which are already, if you're watching the news, just writing down stranded assets at a record pace. And you have Exxon, which used to be the largest company in the world, not even in the S&P 500 anymore. So you're seeing the impact of that before there's ever even an actual tax in the US or a pricing, but most people are calling for a price on carbon. The second subset of risk that we have is physical risk. And because we haven't acted quick enough on the CO2 emissions that we're spewing into the atmosphere, we're dealing with physical risk at a pace that scientists didn't expect until 2050. So the impacts that we're seeing over the past year. And when you think about physical risk, you're talking about extreme weather, extreme heat, floods, droughts, and water scarcity, food scarcity, and freak weather storms like hail, which we can get into a little bit. So now that I've kind of given the color, I want to jump right in. We're going to go in a particular order based on how these companies view the world of climate risk. So we're going to start with Khalid Hussain from Moody's. Please, brief introduction, kind of what your role is in addressing climate risk for Moody's.
Sorry. Great. Thanks, Jeff. Great to be here. So my name is Khalid Hussain. I'm a vice president in our environmental, social, and governance team at Moody's. Moody's is at the heart of what we do is really risk assessment. So be it on the analytics side with MA, or our credit ratings research with Moody's Investor Service, where I'm based. Really what we're trying to do is to get a comprehensive picture of risk. So how do we consider climate risk within MIS? Well, it's really in four ways. One is we have our own broader ESG taxonomy. And really the point of the taxonomy is the answer to the question, what do we find credit material? We've looked at different standards in the marketplace. We have a team of 1,000 analysts. We've been looking at ESG issues for a long time, but really what's changing now is we want it to be more systematic and transparent. Now, within our environmental classification system, we do have a category on carbon transition risk, and we have one on physical climate risk as well. The second step we have is we've got a series of heat maps. We just did a heat map for our environmental part of our ESG scheme late last year. And we found that nearly a third of all rated sectors, comprising about $8.7 trillion of rated debt, were deemed to have high or very high risk to climate change. This is both carbon and or physical climate risk. The third element that we have when we think of ESG, and this of course includes this sort of 15 different categories within ESG, is our in-depth assessments. So we've now been, it's coming up to 2 years since we've launched our carbon transition assessment. We looked at a whole host of different sectors: utilities, autos, refiners. We have plans to look at the steel, cement, and airline sector as well. And really what we're trying to do here is to understand the current market positioning of a given issuer. We want to be able to look at the market, policy, technology forces at play right now. And then really, what are the medium and long-term responses of these companies? On physical climate risk, we have a whole host of different resources. We look at location-specific data from 427. We have our own sensitivity and resilience assessments. And then finally, where this is all coming together for us is in the form of our ratings, of course. Now, all of our, the whole, entire organization is very much committed to, looking at ESG issues in the form of having ESG in our various RC memos. They have to be part of our, various sorts of materials when it comes to assigning a rating. And we found that nearly a third of all private sector rating actions in 2019 had some material ESG considerations. Last point I'll note here, and we'll get into this a bit later on, is how is this all coming together? Well, it's coming together in the form of what we are calling issuer profile scores, which are basically measuring the exposure of issuers to a whole host of ESG issues, according to our taxonomy, and also our credit impact scores, which is the answer to the question, how much impact did ESG have on ratings? So I'll stop there. I know there's a lot that I just went through, but we can go into the specifics of carbon and various aspects of physical climate risk in a second, but I'll stop there for now.
You're muted, Jeff.
Thank you. No video, no audio. So we're going to move over to Chris Hartshorn right now from risQ, risQ. And I got introduced to risQ probably about 2 years ago. And it really opened up my eyes to the amount of data that is now available to really measure physical risk. And when I've always explained physical risk to clients, we've started with municipal bonds and mortgages because it's really the easiest thing for people to just get when you want to talk about, flood risk or storm risk or even heat and the ability for people to work outside or have outdoor activities open. And I was doing that for a while and then saw Chris's data and was blown away by the amount of data that's available on each issuance in the municipal bond industry. So Chris, if you could explain a little bit your role, but also I want people that are listening to understand that we can now measure risk that we couldn't before, which means we can now manage it. And once you can manage it, you can price it. And that's why I keep saying, and you'll hear this, me speaking about this a lot, the great repricing that's coming. It's upon us today. I saw an article just yesterday that Florida homeowners insurance has nearly doubled this year, and that some renters are paying 50% of their monthly rent payment just for homeowners insurance. Chris, take it away.
Yeah, thanks, Jeff. So I'm Chris Hartshorn, the Chief Commercial Officer at risQ. And as Jeff inferred, we're very much focused on US fixed income and the work that we do. So we look at municipal bonds. We also look at mortgage-backed securities. Very much focused on a physical risk lens, but we are looking at carbon transition risk for municipal bond issuers now as well. And there's obviously a whole bunch of data that's under the hood there. The reason it was actually a little bit of a journey to end up in fixed income, end up in muni bonds for us. We actually started by trying to work with P&C insurers and to develop climate change conditioned risk models that focused on the P&C insurance space and kind of build out a traditional catastrophe model. What we found was that insurers care about climate change, but they don't care about climate change. In that every 12 months, they can recalibrate their risk profile by walking away from certain insurance policies, by repricing their insurance policies. And so in a sense, they could recalibrate to climate change every 12-month period on a rolling basis. That left us in a position where we were thinking, all right, so who's actually left holding the bag? Who has a very difficult transition out of their risk? Who cannot reprice their risk? Where are the patches of dirt that you can't walk away from that has long-term assets, long-term debt associated with it? And we very quickly found our way to municipal bonds and latterly to mortgage-backed securities, all of which are defined by long-term debt that is very hard to walk away from, that have tremendous physical risk associated with them. And then once we started looking into that more deeply, we realized that there was not a comprehensive universe of municipal bond analyses out there covering from the largest counties down to the smallest special districts in Harris County, Texas. And neither was there comprehensive analysis of mortgage-backed securities with the level of geospatial granularity that you need to really understand physical climate risk. So we've ended up in those two asset classes, so very much US fixed income related. The municipal bond is most interesting to us, and that's where we started first, because you're actually dealing with both sides of the problem there. You've got to look at the debt that's been issued and what is the risk around that debt for a municipal bond issuer. But by the same token, you're also dealing with exactly the entities and the jurisdictions that would be responsible for investing in resilience and investing in mitigation of physical climate risk in the first place. So by providing quantitative peril by peril analysis for every single issuer, it then allows for the issuer side to talk in a quantitative way about what their risks are to the market, and allows the market to determine how to then think about and price that risk, but then also reflect upon the activities that the issuers are undertaking to mitigate that risk, and really creates kind of a unified construct to inform, quantify, and drive climate adaptation, but then make sure if it is not being driven and there is no adaptation, that the risk, that the residual risk is then priced into the market and everyone can do so with maximum transparency. So that's kind of our journey and where we've ended up in this fixed income space. Our ultimate goal is to make sure there's transparency in the market so that the right decisions are made, that value the assets the right way, that then allow for investors to make informed decisions and allow for the sell side of all of those transactions to also articulate and manage their risk on the flip side. I'll pause there and put it back to you, Jeff.
Thanks, Chris. So we're trying to take you through a little bit of a journey here, and I'm excited for our next guest because I've had a lot of time to talk with both Moody's and risQ over the past couple of years. And what I always kind of surmised is at some point it would be the lenders that would really trigger a pricing disconnection. I thought first it would be the reinsurers and the insurance companies, and secondarily it would be lenders. And when we talk to people that are involved with issuance of debt, it's a whole other ballgame because the risk is squarely set with the company that is making those decisions. So we have Eliza Eubank from Citi, and Eliza, if you could explain where you guys are at this point in your climate risk journey and how you're approaching it.
Sure. Yeah, happy to. So I'll start just by a brief intro of where I sit within the organization, because of course Citi is, one of the world's most global banks. So I'm the global head of environmental and social risk management. I sit within independent risk management. So report up, up the chain to the chief risk officer, sitting next to the credit risk managers, people who are approving loans from a credit perspective. And I've been at Citi always in ESRM, as we call it, for over 13 years, and seen, a lot of evolution and change in that time. I think climate risk has always been kind of one of the bullets on a long list of different types of environmental and social risks that we're looking at, along with, biodiversity impacts, water quality, air quality, community impacts, labor standards, et cetera. And over the last 1 to 2 years, climate change and climate risk has really kind of eclipsed everything else and taken over a lot of the conversation, because I think the mainstream is seeing it more as this existential threat, to the world, to the global economy, to the global financial system. And so a lot more hands are on deck trying to figure out how we solve this problem, and to the topic of this conversation, kind of how we price it into the market. So, we are really looking, within the ESRM policy of Citi, we're looking at our clients' environmental and social impacts, how they are managing those, what their track record is, what the regulatory pressures are on them, and how their management of those risks, both their internal management and the external influences on them, could potentially lead to operational risk, financial risk to the company, and then lead to credit risk and also reputation risk to Citi. And over the last couple of years, we've really been trying to crack that, like, how do you quantify, how do you include this sort of into our internal credit analysis? Because I think historically when we started up, we were more looking at it qualitatively, what type of management systems and policies do they have in place? But this whole climate risk conversation right now is really, can we agree upon sort of a consistent and credible way to quantify the climate risk so that we can integrate it into our internal credit ratings? There's two big avenues of discussion within the banking sector. Is, when do you feel confident enough to include it in your calculation of your internal credit rating? And at what point does it need to be used in your sort of capital calculations? Under Basel III, there's conversations, especially driven in Europe by the EU Sustainable Finance Directive, of should sustainability, climate risk be factored in the amount of capital you need to hold on your books as part of a loan. We haven't yet gone that way yet, the industry as a whole. There's a lot of factors that would drive it. But I've spent a lot of time over the last year with the different emerging climate risk data providers, with the big houses like Moody's and S&P and Fitch, who are acquiring these smaller climate risk data providers, and seeing how you integrate it into the standard credit ratings to figure out, what is the data out there that's available, what new data needs to be made available, what data do we need to collect from our clients so that we can move towards that sort of quantification of the climate risk. So I'll leave it there for now and pick up some of these threads later.
Thanks, Eliza. So when I talk about the great repricing, there's this statement from someone that has been a great mentor to me, Spencer Glendon, on the whole idea of physical climate risk and its impact on the capital markets. And something that he says quite frequently is, when everyone's asking when it's too late. And what we mean by that is everyone is scrambling right now. I mean, you're seeing this from, three distinct areas, ratings, the data, the lender, us as investment managers. I can tell you, I talk to asset managers daily, the largest global asset managers and their risk departments, reinsurers. Everyone is trying to get a handle on physical and transition climate risk, especially with the new administration that is going to be more friendly towards regulatory issues. So we're going to get hit with both. When you think about great repricing, you have two factors. One is risk that you can measure, and two is regulatory issues. And both of those are actually happening at the exact same time right now. we're just getting to a point where we can really fine tune risk measurement. And we're also going to have regulatory support from a new administration that came in. So Khalid, if I come back to you, there are still great challenges though in assessing all of this data and applying this risk to ratings. How is Moody's wrestling with all of this right now?
Yeah, it's a great question. I think that there are a few sort of guiding principles that aid us. So one is, we think that for physical climate risk, we are locked into some degree of impact for the next 20 to 30 years. So, to your point, I think it's foolish to say that we will wait for the physical impacts to occur. I don't think that's true. Based on our analysis of all sorts of climate data and the latest research out there, we do think that it makes sense, to assume that we will have some degree of climate impact regardless of where emissions are. And so what that means is, for our physical risk analysis, we take RCP 8.5, one of the representative concentration pathways, as really the basis for our work for the next 20 to 30 years. And within that, there's of course model uncertainty, but we turn that on its head and say, well, let's look at the range of model outputs, say for heat stress or water stress or so on and so forth. And let's sort of bucket those into low, medium, or high tiers of risk. And let's move forward with that analysis. That's one thing we've started to do for some of our work, with different utilities, for REITs, and so on and so forth. So that's one thing. I think the other thing that we would like to see more of is very granular disclosure. So not just kind of broad-based, company disclosure. We want to be able to look at very specific assets in specific locations. And, that, for us is important because, we have to have a view on materiality. So for instance, for utilities, we want to be able to assess, how much of the utility's service territory, is at risk to different hazards, or which power plants, are contributing the most in terms of output and where are they located. So it's those sorts of things that are important. And I would just conclude by saying, I think that data is improving, but it's not there yet. And we would encourage market participants to put forward more granular data that is also financially meaningful. And on that last point, it's all well and good to have climate scenario applications laid out, but we would like to be able to see how much of that is going to impact your bottom line in various dollar terms, be it in terms of OpEx or CapEx or cash flow. So I'll stop there, but I'm sure my fellow panelists have more to add there.
Thanks, Khalid.
Yeah.
Chris, we're going to come back to you. A lot of people, when they are talking about ignoring climate risk, quote a couple of things. One is that they just don't see sea level rise affecting them as quickly as a risk that they have to pay attention to. And I think, unfortunately, a little bit of inconvenient truth was, some maybe overstatement on rise of water levels and how that would affect people in the United States. And people just aren't seeing that. And they're also quote the fact that there haven't been municipalities yet that have gone, bankrupt because of physical risk. But, at the same time, I like to remind people that, last year we had the warmest temperature ever recorded on Earth. We had the most number of storms coming out of the Atlantic. We had insurance companies walk away from areas like the Keys because of hurricane damage, and walk away from Northern California because of fire damage. So we're seeing a lot of this, but investors aren't yet spooked enough. Can you talk a little bit about why we're not seeing maybe more material impact yet?
Yeah, there is actually material impact if you go looking for it, but you've actually got to have the data in order to build out the correlations in the first place. So there's a whole bunch to unpack there. I mean, the first is I think there is an overt and maybe outsized focus on sea level rise as being the thing you've got to worry about, right? Because it's this big slow moving enterprise. However, the vast majority of physical risk has nothing to do with sea level rise at all, if you look at the United States. So hurricane damage, wildfire damage, and the one that no one talks about but is actually insipid across the country is inland flood damage, which represents a massive amount of the insured and uninsured property value risk that we see across the United States. So yeah, I think we almost like set us sea level rise. I don't want to dismiss it. I don't want to diminish it, but I think it's important to keep it in context versus the other physical risks that are out there and actually incredibly damaging and are damaging now. The other part of that is, I think, looking backwards to make any assessment of climate risk is a fool's errand and is predicated in just a really bad construct of looking at historicals to look at future climate change, which is just, to use my Gretzkyism, I think we do want to skate where the puck is going on this one. And not to do so would be an overt abandonment of one's fiscal and fiduciary responsibilities. Beyond that, there is already signal that we can now see that there of the fundamentals that one would look at when analysing the health of a municipal bond issuer. So, for example, using all of our methodologies where we can look at property value at risk for every issuer, we can look at GDP impairment risk for every issuer, we can now correlate those risks backwards to recent changes in population. So population growth or lack thereof, we can now correlate to climate risk. The appreciation in property values or lack thereof, we can now correlate to our climate risk models that we've developed. If you think about that, population and property values sound like two pretty important underpinnings of a municipal bond issuer's health. I think any ratings agency would look at those as being fairly concrete indicators of issuer health. Beyond that, we've just completed a study together with our friends at Municipal Market Analysts, so Tom Doe and the team at MMA, where we've been able to correlate historic climate events to credit to municipal bond issuer impairment based on MMA's issuer impairment data, wherein at the high end of climate risk, you get a 30% increase in the probability of impairment of that issuer. So that's not abject and outright default, which is what everyone focuses on. That is the impairment of the ability to pay in a timely fashion. So now we're seeing population, property value, as well as payment impairment in the municipal bonds being correlated not to future hand-wavy climate change, which I'm not saying is hand-wavy at all, but actually to past performance and past observation. That's all only going to amplify over time once you factor in the climate change models, whether it's RCP 8.5 or even at a 4.5 level, which we're using. So defaults, not at a, no county, no city, no state has defaulted. That's exactly right. There are underlying health indicators which point towards future default, particularly, and future impairment, particularly when you're looking at higher, inherently higher risk issuers in the first place. It doesn't take much to imagine a double whammy coming over the top and starting to put sort of much higher probabilities of impairment or default layered onto the existing municipal bond issuers. So plenty of data, plenty of indicators. It's just a matter of, I wouldn't even wait and see because you won't have to wait too long.
Thank you, Chris. Yeah, when I started doing this, I guess 7 years ago, we were talking a lot about mitigation strategies. And then we were talking to people about adaptation strategies because it just didn't seem like we were going to be able to get ahead of the physical and transition risks we were facing. And then we started talking to some bond issuers that started talking about abandonment strategies. And you mentioned the word abandonment when you were just speaking. And first time I heard that was from, I think, Alliance Bernstein 2 years ago. And someone in the audience said, well, what do you mean abandonment strategies? And they said, well, at some point, if the insurer walks away, the debt holder's stuck. And what most people don't realize is that in your mortgage clause, it actually says that you guarantee that you'll hold mortgage insurance annually, and you lock yourself into a 30-year mortgage, guaranteeing that you'll hold mortgage insurance for that entire time. even though that renewal is annual and the insurance company could walk away at any time. So it's definitely just an unpriced risk in the market right now. Eliza, we're going to come back to you. I'm really curious because you're sitting in a different position. You know, we're all analyzing data and trying to make investment decisions based on the data, but you've got to make some really serious decisions about, you know, lending and long-term risk that's directly impacted to the bank. Are you starting to see a disconnect between borrowers and lenders about the risk? And is it leading to some tough conversations sometimes with people about risks that they're just not really assessing on their own yet, but the bank is forcing them to assess? And how does that tend to go?
Yeah, no, that's a good question. And I will say we're definitely seeing, you know, raising awareness across the board on these issues. You know, it's not like we're having to convince our oil companies, clients that that these are real issues, because they're hearing from, you know, from their investors as well. They're hearing from all of their banks. So, you know, we're certainly going on this journey kind of together with our high carbon clients. I think as the world's most global bank, you know, our portfolio very much looks like the global economy. And so, you know, we have a lot of clients in the power space, you know, a lot of clients in industrials, and in oil and gas. And they're reaching out to us often. We've been having these conversations specifically with oil and gas clients for, you know, it's been several years that, you know, we've been meeting them to talk about the increasing expectations on ESG disclosures that investors and banks have of, you know, extractive companies, specifically oil and gas with the climate. You know, we've been meeting with them on their TCFD disclosures, as well as how we're kind of evolving our own climate
Eliza?
portfolio. Yep.
Can you just explain to the audience what TCFD is?
Oh, sure.
That don't know.
Yes. So the Task Force on Climate-Related Financial Disclosure. If that acronym doesn't roll off the tongue for you, practice it until it does, because you know, that's really had a lot of uptake across the financial industry and across corporates. So TCFD, Task Force on Climate-Related Financial Disclosure, came out in 2017, really from the Financial Stability Board, saying, you know, corporates, investors need to understand climate risk. They sort of really popularized the notion of physical risk and transition risk, and said every company needs to have a strategy for how you understand and minimize your climate risk. You need to have governance over how you manage it. You need to have like a risk management policy, and you need to have metrics and targets in terms of how you try to reduce it. And you need to be disclosing all of this to your investors so that you can start having more of that, you know, transparency that Chris talked about, you know, is your goal. Everybody is interested in more sort of data certainty and transparency, so we can all be making decisions on sort of the same pieces of information. So Citi did our first TCFD report in 2018 and released our second one just in December. And we've met with a lot of our clients, you know, specifically looking at our oil and gas and power clients at kind of what are their low carbon transition strategies, how are they measuring and disclosing their own climate risk and making steps to reduce it. And, you know, we're almost these days getting just as many inbound inquiries as outbound inquiries too. Maybe that's an over exaggeration, but, you know, we're asking to have these conversations with our clients, but they're also coming to us, you know, because we do both a lot of work in the capital markets as well as in the lending. And you know, just today I had, you know, a client of, you know, a manager internally for Citi for a large oil and gas company in a jurisdiction that you wouldn't think would be completely, you know, progressive on climate issues, saying, we want to understand how investors are looking at us on climate. What are the metrics that they're using? How do we need to be kind of more transparent in talking about these issues? So there's definitely awareness across the board. And then at Citi, we sort of talk about how, you know, we want to be banking the low carbon transition, but we need to be doing that kind of with our clients, helping the economy as a whole move, as opposed to completely, you know, moving away from whole sectors.
Thank you so much. Khalid, we're going to come back to you, and we're in the last quarter of our presentation. So let's start talking a little bit about the future and what is Moody's doing to really address climate risk analysis going forward? What are some of the things that we could look forward to coming out of Moody's, and how do investors kind of try to start digesting that information, and what ways can they do that?
Sure. Yeah. I mean, as I mentioned earlier, we want to continue to do carbon transition assessments for risky sectors. So we've already done some assessments for refiners, autos, and utilities. We want to continue it for steel, cement, airlines, other types of oil and gas sectors. I think for physical risk, we've got a good handle on scenarios, and we've published some reports on sea level rise, heat stress, REITs, nuclear facilities, et cetera. But really the goal for us now is to bring it all together. And the way we're going to try to do that is to have a series of issuer profile scores, which will be comprised of different ESG categories, two of which will be carbon transition and physical climate risk. And really the point of these scores, is to systematically assess the level of risk for each issuer that we rate. And so it's a pretty mammoth undertaking. We've started with sovereigns. We want to continue that with a number of corporate sectors in the next few months, and kind of roll it out in waves for the rest of this year and into next year. And that's how we see that really all coming together in a more systematic and transparent way. And of course, that's going to feed into our credit analysis. It's going to be a very consistent and comparable way to look at this data.
And do you imagine at some point that it'll just be one rating that just incorporates it? Because I know now you're offering two different, rating systems coming out. Do you think at some point they converge and climate is just baked into a traditional rating model?
Yeah, potentially. I mean, we will have a separate score that will be a credit impact score, which will be answering the question, how much was the rating affected by ESG issues? I think for the time being, we want to maintain, these sort of separate rating systems. I mean, they really measure different things. So, I can't say when or if they'll even converge, but obviously, we've seen a lot of, interest in the market, and it's been accelerating year after year on ESG and climate issues. So hard to say, if and when they'll converge, but it's something we're obviously wrestling with ourselves.
Thank you. Chris, let's go back to you for a minute. One of the things that is newer for risk, when I first got introduced to you, you guys were doing municipal bonds, but now you're doing mortgages as well. And you touched on something when you were talking before. You basically said that there's migration patterns that are being watched as well. And I don't want to not touch on this, and I don't want to put you on the spot at all. But one of the things that we have to be aware of is that just like the pandemic exacerbated social justice issues, climate change is going to do that, tenfold. Because when we talk about migration patterns, we understand that some people can just afford to pick up and move and migrate because of differences in climate-related issues. But when you're looking at migration patterns and the revenue that those municipal bonds or even mortgage areas, you're looking at specific inland flood, is there any way to take into consideration that data that this is disproportionately affecting people that can't afford the risk already?
Yeah, and that's actually part of the work we're doing is in the course of doing complete physical risk sort of quantified analysis for these different types of securities. We've also overlaid a lot of the demographic and socioeconomic factors that you've got to think about. So population and property value and demographics and race and affluence and all the rest. And there are actually some I would call them interesting and, to be honest, relatively disturbing outcomes that one can find once you start layering on all this data. For instance, when you actually look at the differences between FEMA's SFHA areas, special flood hazard areas, and layer that on top, the difference between the SFHA amounts and then where flood and what the quantification of flood is when you take a proper hydrological model and a more complete one, you actually find there's a bigger gap between the flood that's assessed in the FEMA maps and the flood that in reality exists in areas that are lower affluence. So you find that there's a sort of a disparity between those two things that grows and changes with the degree of affluence that you see in a given area. That's important because a lot of the triggers that then follow on from that in terms of flood insurance, in terms of requirements for flood insurance, in terms of costs of flood insurance, all roll through from those types of observations. So clearly there's no, you've got a built-in sort of disparity between that's built on affluence. On the flip side of that, still looking from the affluence lens, when a climate event does occur, you find that there's a claims process that has to occur either through insurers or through FEMA. And whether it be what happened after Harvey in Houston or what happened recently in the Oregon wildfires, there is a disparity in terms of successive claims, of FEMA claims, that you can again correlate to the degree of affluence in a given location and the affluence of a given population, where the higher affluence people have a greater ability to navigate through all of the paperwork and all the requirements that it takes to actually get your refund done and get your claim from FEMA as well. So time after time after time, you can actually build in these factors which leave sort of an increasing disparity of capability that you can correlate to affluence versus the climate risk that occurs. That's all then going to come across into the ability to pay for insurance on the back end of this, and who has the ability to pay for insurance and stay where they are, who has the ability to pick up and leave and go somewhere else, which will also correlate to affluence. But Jeff, to your point, everywhere you look in this thing, there's an intimate tie between affluence and climate risk, the ability to adapt to it, the ability to recover from climate events. And so I don't look at climate risk as an E issue in isolation. It's an S issue writ large. And quite frankly, it's a G issue as well, given the, I would say, borderline disgraceful levels of disclosure of climate risk that exist coming from municipal bond issuers. I would say that's a massive G ding as well. So climate's tentacles go through this thing from top to bottom, and there's really no escaping from it. I'll pause there and dismount from my soapbox.
Thank you, Chris. And that was not a setup, so I'm glad you fielded it well. I wasn't sure how you would do with that one, but thanks. That's exactly some of the information I was looking for. I just want to say too that as a wealth management firm, we offer climate adaptation strategies. That's what we specialize in, and that's what we've been looking at for the past couple of years. And we do think that the risk of not adapting to climate in the next couple of years is much larger than people are assessing currently. So if anyone wants more information about that or how to approach that, we threw some information in the chat room. Eliza, what's next? We've come a long way in 10 years, I think in the last 3 or 4 years, since certainly TCFD came out. And then last year we had the Commodities Futures Trading Board, which was the first bipartisan commission, really, actually run by a Trump appointee, come out and say that the single biggest risk to the capital markets was climate change, and that we needed a carbon pricing quickly. And there were oil executives on that and banking executives.
And me, including me.
Oh, excellent. So maybe you could tell us a little bit about that and what do you think is coming next?
Yes, well, definitely the CFTC Advisory Committee report, it was like, it's really, interesting because it's sitting at a global bank, but an American bank working globally. We're compared against our European peers who are really pushed by, a lot more regulatory tailwinds to take these issues seriously. And so the last 4 years, obviously, the regulatory pressures in the US were kind of going the opposite direction. So the CFTC report was the first time that a US financial regulator was really kind of trying to focus on this climate risk issue and think about what do US financial regulators need to put in place. We're seeing, a really rapid change of direction with the Biden administration coming in. You're hearing talk about SEC, ESG disclosure. We've certainly heard from people on the Hill who are interested in putting in place certain climate financial regulatory requirements. The Fed has now joined the Network for Greening the Financial System, which is the network of over 65 global central banks who are looking at climate risk and environmental risk in their regulation and supervision of banking activities. So, that was one of the recommendations that we put in the CFTC report. I think that's really important to have some kind of global consistency if we're all going to be asked to do climate scenario analysis or climate stress testing. Can we have similar, approaches around the world for us global banks who have to do it in a lot of different jurisdictions? But we, at Citi, we're already facing climate risk banking, regulations across, from the Bank of England, across Europe, from the European Central Bank, in Singapore, in Hong Kong, Australia is coming out. So I think it's only a matter of time until we start seeing more formal expectations in the US on banks integrating climate risk into their risk analysis, their sort of pricing of loans. And, that also needs to come coupled with more granular disclosure, as I think Khalid had said. Can we get more granular disclosure from all corporates on these types of risks? Because, banks on our own, we can't be doing carbon accounting or sort of, in-depth analysis of all of our clients. There needs to be increased transparency across the board. So the whole notion of climate scenario analysis, banks doing climate stress testing on their loan books, that's where, a lot of sort of thinking is happening across the world. And we expect to kind of see that type of ideas bubbling up in the US in the nearer term, in the next couple of years.
Well, thank you so much. I want to thank all our participants. This was a great panel for me. I think it was just excellent that we kind of came at it from 3 different areas, and it made it, to me, incredibly informative. Mike, I'll turn it back over to you.
Well, again, Jeff and all the other participants, thanks for a lively discussion. Please remember that we do have an event coming up on Thursday. Hopefully some of you will sign up for that. And hopefully all of you will take into consideration membership. It's fairly low cost and the information can be found on our website. So once again, thank you all for attending and have a great day.
Thank you.
Thank you.
Thank you.